Good morning. My name is Ashok and welcome to my channel called Read to Expand. In today's video, I'm going to talk about two tax saving products, namely Public Provident Fund and the ELSS. That's called Equity Linked Saving Scheme. Post my last video, I have received certain phone calls and people have requested me to do this kind of comparison. And hence in today's video, I'm going to specifically address that what is PPF, what is ELSS, and how the returns have been, generated over a period of time, and which particular product is best suited for the investor to create a long-term wealth. At the same time, also save a tax under Section 80C. So let's begin, and let me share my screen with all of you. So first, we will understand what is ELSS. That's called Equity Linked Saving Scheme. And we'll also see the basic definition of what is called Public Provident Fund. So ELSS basically is the only product under the mutual fund category which helps the investor to invest under Section 80C and save tax. You can invest into this particular mutual fund up to 1,50,000 rupees in order to save tax. However, it's not limited to that you need to only invest up to 1,50,000. You can invest more, depends upon your investment capacity. Okay. I would also like to inform you that when you invest money into the equity linked saving scheme, the money normally invested into basically the money invested into the ELSS scheme is actually goes towards the equity, I mean, so the stock market. Okay. And the performance is basically the market linked. So with these basic understanding of ELSS, let us see how what is called how this public provident fund works. So the public provident fund is basically initiated by the government of India. Okay. And in this particular scheme, also you can invest the money and save tax. Up to 1,50,000 is deductible under 80C. Okay. You can also open a joint PPF account for a minor as well as with the parent or the legal guardian. Okay. Now let's see the comparison between the public provident fund and the equity linked saving scheme. Okay. So the first, I would like to inform you that the risk which is involved into both the products. Okay. Public Provident Fund is initiated by the Government of India and it is a safe investment. It is considered as a safe investment. Whereas a equity linked saving scheme are basically, as I mentioned to you, that is linked with the market. So the fund units what you have bought over a period of time, if the market goes up, your value go up. If the market comes down, then definitely the value comes down. Okay. So it is a market linked. Okay. What returns you can expect into the PPF and ELSS? Well, in the PPF you can expect 7 to 8% or maybe 8.5% over a period of time. Whereas in ELSS scheme, you can expect anything between 11 to 14%, depends upon the kind of time you have invested into the market. Because in order to generate return, you have to spend time in the market. I just said in my last video also that rather than timing the market, you should invest time into the market. You should see the different kind of market cycles, maybe one or two market cycles. You have to see that market goes up, comes down, then again goes up, comes down, and then finally market makes a new high. Okay. So so if you invested for a considerable number of years, it had generated around 12 to 14% approximately. What are tax benefits? In the PPF, the investment amount is exempted from the tax at the time of investment, accumulation, and withdrawal. Whereas in equity linked saving scheme, the 10% LTCG, what we call as a long-term capital gain tax, is applicable if the returns are over and above 1 lakh after the holding period of 1 year. Okay, so we need to be very, very clear on the tax part. Lock-in period in public provident fund, a lock-in period of 15 years applies. After the fifth year, you can do the partial withdrawal of money. Whereas in ELSS, the lock-in period is 3 years. However, there is no possibility of premature withdrawal. So this is the thing also we need to understand, that in equity linked savings scheme, the lock-in period, the minimum lock-in period is of 3 years only. Okay. Time limit, you cannot invest for more than 15 years in PPF. However, you can extend to 5 more years. Whereas in ELSS, you can invest as long as you want. There is no upper limit application. How much money I can invest into the PPF? You can invest anything between 500 to 150,000. That means 1,50,000 rupees in a financial year, either in lump sum or 12-month installment. Whereas in equity linked saving scheme, you can invest as much as you want. However, under Section 80C, you can only claim up to 150,000 rupees as a part of your tax saving investment, not beyond it. Okay. So with this understanding of PPF and ELSS, let us see the kind of return generated by different kind of ELSS schemes which are currently prevailing in the market vis-a-vis public provident fund. So I have taken this particular example, okay, ELSS versus PPF return. And this is the place where you have to put your thinking hat in terms of what is good investment for you, and you need to decide what very, very wisely. So I have taken the data from the 2008, okay, because at that point of time, market was totally down because of your Lehman collapse and other and whole host of other factors. I have taken data from 14/9/2008, okay, and one more tax saving fund called Nippon India I have taken from 2013 actually. Let me remind you one particular thing. I really do not know how many people have seen that particular cycle. Okay, 2008 the market was totally crashed. 2009 market have recovered, and from 2009 till 2000 I think 14. Yes, I think 2014 market has not given a single return. Let me tell you, it was the time when market was really, really grinding. It was testing the patience of the people, that, market test your patience. See guys, I just want to tell you one thing. Generating wealth is not easy, and market is going to test your conviction. Market is definitely going to test your patience. Okay. And then only it helps you to generate wealth. So this is the period I have taken it purposely to demonstrate that despite that market giving no return from 2008 till 2014, there will be a lot of ups and downs, but market was really, really grinding, and I have been part of it. I have experienced it, and I know the kind of pain person goes through during that particular period. Okay, but despite all that, I have taken the data from 2008 till 2023 actually, and you can say that if you have invested 10,000 rupees in 2008 or 2013, what is the value and what is the kind of annualized returns have been generated by the ELSS scheme in comparison to public provident fund. Okay, let us understand that your returns are none of the tax saving instruments which I have taken. I have purposely taken, instead of one or two, I have taken 4 tax saving instruments from the different AMCs, and you can see that none of them has given you less than 12% kind of a return. Okay, and what is the kind of line which, or what is the kind of return which have been generated by the public provident fund? Let us understand with one of the product, which is called the SDFC Tax Saver. Okay, if you have invested, I have taken a very long period of SDFC Tax Saver from 1996 and want to demonstrate that data to you. The reason behind it, because 1996 India, you know how the India was actually at that point of time. And then in 2000, in the year of 2000, there was a total dot-com bubble. In fact, that is the time when I entered into the market, to be honest, and that was by an accident, that how I entered into market actually in the year of 2001, to be precise, not year 2000, because in the year 2000, dot-com bubble has happened and the market was again grinding mode from I think 2000 till 2003, 4, I think. But I entered into the market around 2001, late 2001 actually, and that too by an accident. In some other time, I will talk how I have entered into the market. But I've taken the data from 96, and and a person, let's say, investing 1 lakh rupees into the PPF scheme, and at the same time, one of our tax saving instruments called SDFC Tax Saver, and the person is investing from 1996 till Jan 2022. Okay. Do you know the kind of return which have been generated by the end of Jan 2022 is basically you have generated in the public provident fund is around 90 lakh rupees. Okay. Whereas in SDFC Tax Saver has given you more than 8 crore of rupees. Okay. So you can just imagine that the amount what you have invested 1 lakh rupees, every year into the public provident fund, and the same amount you have been investing into the SDFC Tax Saver for a tax saving purpose. On January 2022, the total amount invested, you can consider, let's say, 21 years and another maybe 4 years or 3 years, around 25, 26 lakh rupees or 27 lakh rupees you have invested as your capital. In public provident fund, your return is around 90 lakh, which is not a bad amount, let me tell you. Okay, over a period of time, you have invested around 25, 26 lakh rupees. You have got around 90 lakh rupees in return. Whereas in SDFC Tax Saver, you have generated more than 8 crore of rupees. So just imagine the comparison of returns in PPF versus the equity linked saving schemes. Yes, I do agree. I do agree that equity linked saving schemes are linked with the market. I'm sure the person must have experienced a lot of ups and downs during this particular period. But if the person has hold on to his investments and continued, then today the person has made his fortune into the SDFC Tax Saver Fund and also saved the tax on top of it. So make no mistake, I am not propagating or saying that you should only invest into the ELSS scheme and you should ignore the PPF. What I'm just trying to say that you need to take a wise decision based on your risk taking capabilities and based on your investment capacity. What is the right kind of investment for me? Okay. So I just want to tell you certain things that PPF or the fixed deposit kind of instruments or the products look safe. I'm not denying it because backed by the government of India or backed by certain things, and they look safe. Whereas the mutual fund basically is linked with the market. If the market goes up, your value goes up. If the market comes down, your value comes down. And at the same time, I'd also like to tell you that if you are invested into the market for a period of 7 to 10 years, then your losing money probability becomes almost zero. Okay, and you generate wealth for yourself and as well as next generation. As I have shown you in this particular chart, that what is the kind of return have been generated by the equity linked saving schemes. Whereas into PPF or the fixed deposits, the things look safe, but is it really safe per se? Because in the last video, I have explained you the concept of the real return and how your purchasing power comes down over a period of time because of the inflation. So you really need to understand the concept of real return and how, where you are going to generate wealth for yourself by beating inflation. That is the question you need to ask yourself. And I'm sure this particular chart has helped you to understand that where I need to put my money and why I should put my money. What is the goal I want to achieve by doing this particular investment? Okay. So with these words, I would like to say, think wise, determine your goal, and put your investment into the right kind of instruments, okay, to generate wealth and protect yourself from the inflation purpose. Okay. So with these words, I would like to end this particular video. And I would like to say thank you very much for your time, for watching this particular video and giving time to me. I'm very, very thankful to you. If you like this particular video and if you learned something out of it, kindly put a comment and I will personally read those comments and reply you back. If you have any questions, please do not hesitate to connect or put your questions into the comment section and I will definitely reply to it. At the same time, if you can share your this particular video with your friends and family, it might help them in some other way. And thank you very much for your time and happy investing. Thank you very much.